We all want to leave as much as possible to our family and loved ones. In the UK, the first £325,000 of an individual's estate is free from inheritance tax. But everything over this could be taxed at 40%. So without careful planning, HMRC could easily become the largest beneficiary of your estate, leaving a large tax bill to settle. The Wealth Preservation Account from Canada Life is one way of generating additional capital for you to use whilst also reducing your potential inheritance tax liability. By investing in policies which are then held under a flexible reversionary trust, you retain access to flexible yearly payments. Investing in the trust will start a 7-year clock, after which the investment will sit outside of your estate for inheritance tax purposes. And any growth on the money is outside immediately. So how does it work? Let's look at an example. Sally invests £100,000 into the Wealth Preservation Account. She splits this over 10 years, with 5 policies of £2,000 maturing each year. For the first 3 years, Sally has no need for additional income, so the maturing segments are moved to the end of the conveyor belt, creating an 11th, 12th and 13th year. Towards the end of year 4, she wants some extra money to buy a new car. The trustees she has nominated let 2 policies mature, so they fall off the conveyor belt and pay £4,000 plus any growth to Sally. The growth is subject to her marginal income tax rate. The remaining 3 segments are again moved to the end of the conveyor belt, creating a 14th year. At the end of year 5, Sally doesn't require any money, but she's planning to take her family on a worldwide cruise in 18 months' time. So the trustees move 3 of the maturing segments along 1 year, with the remaining 2 segments moved to the end of the conveyor belt to top up year 14. A year later, and Sally and her family are just a few months away from setting sail. The trustees let all 8 segments mature, paying £16,000 plus any growth to Sally. Towards the end of year 7, Sally's daughter Amy turns 18 and is about to start university. Sally would like to help her financially. The trustees can surrender 3 segments and Sally will be taxed on these. Or they can assign the 3 segments to Amy before they surrender them. This way they are assessed on Amy's tax position, and as she has no other income, there could be no tax to pay. The Wealth Preservation Account is designed to be flexible. Even if you don't expect to need the money, it's good to know the options are there should circumstances change. And when that clock reaches 7 years, it's free from inheritance tax on your estate. So the next generation can benefit during your lifetime and long after. If you'd like to know more, you'll need to speak to your financial advisor.